Hi, I'm Sarah Kenna from Company Matters, Link Group's company secretarial and corporate governance team. In this episode, we play back highlights from our recent AHEAD event. During the session, our panel of guest speakers spoke about corporate governance highlights of the year so far. They also discussed what to expect in the second half of 2022. AHEAD is a community for governance professionals to discover new trends, ideas, discuss industry issues, and connect with like-minded people. If you'd like to learn more about future events and join in, I'll leave a link in the description. It's free to join and we're always open to new members. I'm now going to pass you over to Kathy Cong, who will introduce the guest speakers. I hope you enjoy.
Welcome to the AHEAD's Corporate Governance Mid-Year Review. There are a number of topics we will be discussing today with our panel of expert speakers. So let's begin. My name is Kathy Cong and I am Managing Director of Company Matters and the AHEAD Programme sponsor. The panel of expert speakers with me today are Maureen Beresford, who is Head of Corporate Governance at FRC. Prior to joining FRC as its Head of Corporate Governance, Maureen was Head of Company Law and Reporting at BEI and was responsible for a team who informed company law policy and supported ministers on a number of legislative changes. Whilst being seconded to the FRC in 2017, Maureen worked on the review of the UK Corporate Governance Code and introduced the Waits principles for large private companies. Our second expert speaker is a member of our senior team, Courtney Menzies. Courtney is an experienced lawyer in the governance profession with over 20 years experience in a range of sectors. Prior to joining Company Matters as one of our senior managers, Courtney was Deputy Company Secretary of British Airways. And prior to BEI, she has operated at senior level for corporate providers and in-house COSEC teams. Third speaker is our very own Head of Industry at Link Group, Jay Baker. Jay works closely with market peers, issuers, clients, and central government and other stakeholders. Jay is also the immediate former chair of the Governance Institute's Registrars Group and is an industry-recognized expert in the post-trade environment. So, Jay, turning to you first. How has the 2022 AGM season so far compared to the last 2 years? And if you could, and can I just follow up with another question? And have we seen any changes continuing post-pandemic?
Well, thank you, Kathy, and good morning, everybody. Well, proxy voting has definitely changed. If we go back to 2021, we saw a reduction in proxy appointments down from 64% of capital voting in 2020 to a little under 57% in 2021. So a big reduction there. This year, though, we've already seen that rise to almost 70% of capital voting. So back really to pre-pandemic levels. But more than that, behaviours are changing. So in 2020, for example, almost 50% of all proxy appointments were done on a physical form, but we saw that changing as well. So in 2021, that was down to 44%. And then already in 2022, we've seen a massive reduction of those physical forms, now only down to about a fifth of all proxy appointments coming in physical form. So what we have seen is a big shift now to electronic, and electronic is definitely now the main route to proxy appointments, which is, I think, where all the corporates and issuers would want to see the trend moving to. But that's also translating over to how AGMs are held, as more and more companies are providing a digital option for the AGM. Of course, that was helped by the temporary legislation during the pandemic, which was accelerated by demand. In many ways, the UK is fast catching up with the rest of the world on a digital meeting. And if we look at what Australia have done, which is where our parent company is based, hybrid and virtual meetings are very much a stay of the AGM scene and is becoming more so in the UK. America is also way ahead of where we are in the digitalisation of the AGM and the shareholder meetings generally. So big changes since the pandemic and changes in the right direction. We saw that curve go down and we've seen it go right back up again to pre-pandemic levels. So definitely in the right trending route and a shift to the digital. So yeah, good news story.
Thanks for that. I mean, definitely the whole electronic and hybrid is the way forward. With that happening, just touching on voting level and, within our client portfolio of companies who've held their AGM so far, it's been, there's some indication that voting level a little bit on the low side. So what could we do better, or issuer could be do more or better in terms of engaging with their shareholders to increase voting?
Yeah, that's a really tough question, actually, Kathy, because in my view, there does appear to be some shareholder apathy in voting, and I suppose we have to ask, why is that? And I've often said that, do retail shareholders feel that their voices aren't heard and their vote doesn't really count? And perhaps that's true, and they do feel like that, and I'm sure that is right. But technology is providing better access for the retail shareholders. There's the hybrid and virtual meetings, meaning shareholders can attend remotely, of course, and we've just talked about that. But at Link, for example, we've developed an engagement app called Link Vote Plus. That doesn't just provide a simple route to proxy appointments, but it also includes like a one-stop area for shareholders to gather or connect to their information. And the app also links into investor relations sites, for example. It pulls down the RNS announcements. There's a document repository and even integration to various map applications. So if a shareholder who's walking down the street doesn't know how to get to the meeting venue, he can use the app to find a way there. And not only that, the app provides access to the hybrid or the virtual meeting. So we're at a point now where engagement with the shareholder can be done much more easily in one form, in one place, without the need to use disparate systems and disparate routes to engage. And these developments, in fairness, I think will make access so much easier. But not just for the shareholder, I think for the companies too, because it will provide additional communication channels to the retail shareholder with push messaging, maybe SMS messaging, and other things as we develop and perhaps understand how we can better use social media, for example, to engage with shareholders. So there's digital options coming down the track, and I mean that actually, if you don't mind, that leads me on to another question. And if you don't mind, Kathy, I'm gonna pass one over to Maureen, because I think it links in quite nicely. We've got the shareholder meeting guidance soon to be published by the FRC. So again, one for Maureen. Maureen, are you able to give some background on that meeting guidance and an expected publication date? And I think that will help determine what the feeling and what people's expectations are going to be for the future.
Thank you, Jay. Yes, I think I can give you some more information. Just a little bit of background. We started working on this probably 18 months ago, and we've got a wide range of stakeholders discussing guidance with us, from the retail shareholders right through to GC 100. So we're trying to get agreement from a disparate group on some fairly basic guidance, but the guidance we hope will be out in July. The aim is to cover a number of issues. So Jay talked about technology, so how to kind of engage with technology, some good practice that companies might want to think about in terms of using that technology. I think it was great to hear that Jay's app, we're really supportive as like a one-stop shop approach, but also for companies to take forward better engagement with all shareholders, not just the large shareholders, but those retail shareholders as well. So the guidance is split into three elements, really. Suggestions on what to do before meetings, during meetings, and after meetings, with a definite emphasis on this engagement with your shareholders throughout the year. The AGM still being almost the pinnacle of that, but also bringing all that information that companies have learned throughout the year to that AGM at the end of the year, and kind of feeding back all the different views that have been made, and making it an AGM that's not just about the business of the day, but a little bit more interested on issues that aren't normally there, aren't normally discussed. So yeah, the guidance hopefully in July. Fingers crossed. That's probably all I can say at the moment. We're still getting it signed off.
Oh, Maureen, not even a tiny little hint before even the sign off, Maureen. Just a
I
little
said
bit for our
July.
audience.
I did say July.
All right, and we
Mid-July.
can.
There you go.
Well, next Friday is July the 1st. Can we get something by then? No. Okay, thank you for that. So just looking at it from the perspective of the COSEC, and this is a question to you, Courtney. Given that more companies have changed the articles to allow for hybrid AGMs, what are the practical considerations that COSEC would need to be aware of when they are planning the AGMs?
Well, during the pandemic, temporary relaxations to meeting attendance requirements were introduced, and those overrode the provisions in companies' articles relating to meeting attendance, and they essentially allowed closed meetings. But as relaxations ended, many companies wanted the flexibility to be able to hold virtual and hybrid meetings going forward, so they made amendments in their articles to be able to do this. It's also worth noting that although hybrid meetings are permitted, there have been some questions over whether UK companies can hold purely virtual meetings, including whether the Companies Act requires an actual place of meeting. So purely virtual meetings are not recommended, although there's been one really well-known example of a purely virtual meeting being held. And if you're into your fashion, like I am, it was Jimmy Choo. So if you want to go ahead and plan a hybrid AGM, firstly, you should check your company's articles. You should see what the provisions allow for. The CGI, formerly ICSA, has confirmed that companies can legally hold hybrid meetings, even if their articles don't specifically provide for it, as long as the articles don't specifically require physical presence in a single location or actually prohibit electronic participation. Then I would make sure that your AGM notice contains all the relevant information, including making it clear that the meeting will be hybrid and how to attend and vote virtually. Then I would look at attendance. So who will actually be attending? How many shareholders and speakers will you need to allow for, and where are they located? How will you register attendance? How will you verify shareholders? If you're expecting minimal attendance, you also might want to think about whether it's actually cost effective to hold a hybrid meeting given the equipment you'll need. Then I look at the venue. You'll need to choose a venue which has both the space and the equipment to allow for equal participation for both in-person and virtual attendees. And finally, you might want to consider what your actual reasons are for wanting to hold a hybrid meeting. Is it actually likely to encourage better participation? So a large proportion of our clients have amended their articles to allow for hybrid AGMs, but actually the take-up this year has been minimal, and we've seen that it's mostly been down to the costs involved.
Yeah, I think I'm sort of there with you as well. And actually, the company that I was a group COSEC of was actually one of the first to hold a hybrid AGM in the UK. I think across the world, someone else beat me to it. So that's actually quite interesting. And hopefully, I mean, I think the concept is great. I think the cost implication is something that the company needs to bear in mind. So now I'd like to move on to the FCA's rules on diversity-related disclosures. And again, this is coming over to you, Courtney. 89% of FTSE 100 companies had met the diversity-related target by the end of 2021. And just over half of FTSE 250 companies have met that target, 55%. That still leaves a percentage of companies that are choosing to explain rather than comply. So what are some of the reasons that you're seeing that companies would choose to explain rather than comply?
Well, that's right. There is a large percentage of companies that are choosing to explain rather than to comply with the new targets. And many companies that we've spoken to take the view that where there's a limited pool of talent, especially in certain industries or smaller companies with smaller boards, it's not always possible to meet the target. Some companies have actively tried to attract a more diverse set of candidates, but have been unable to do so far. So these companies will need to have robust explanations and strong succession plans in place to address the issue.
And I guess it is still sort of early days in current, definitely in this current reporting season. But how are shareholders and proxy voting agencies reacting to this response from companies, who are new to the rules so far?
Well, we've heard talk in boardrooms that there are rumblings from proxy voting agencies and institutional investors that they plan to take these targets very seriously. And where the targets are not met, they will vote against the chair of the nominations committee or indeed even the chair of the company. So proxy voting agencies have already begun to take this stance. For instance, both ISS and Glass Lewis have said in their 2022 proxy voting guidelines that there is an expectation for FTSE 350 companies, excluding investment companies at the moment, for the board to comprise at least 33% of women, in line with the recommendation of the Hampton-Alexander Review. Further, they expect all listed companies will have appointed at least one gender diverse individual and one from an ethnic minority background. And they are expecting the board to be reflective of a company's employees and the location that it conducts its business activities in and its key stakeholders. And where boards fail to do this, they will expect to see clear and transparent disclosures as to why they've been unable to do it. And the other proxy voting agencies have expressed similar guidelines. And I would expect all of them and institutional investors to start taking quite a hard line on diversity in the future. And as we've seen in this year's AGM season, the proxy voting guidelines really do sway the votes of investors.
It's tough out there, isn't it? Being a board of directors and what they need to do. I think the concept is great. But actually to achieve the target is pretty challenging. So what do companies need to be aware of when they are planning to meet these new targets? Are there any middle grounds that they can, again, is the sort of like the explain element of it?
Well, as we said, not all companies will be able to meet the targets, or at least not straight away. So where the composition of a board doesn't align with the targets, companies will be expected to provide adequate disclosures to address it. So it might be that a board consists of 4 or fewer directors, where a company discloses a credible plan to address the gender or ethnic imbalance on the board within a defined time frame. And that is key. It has to be within a defined time frame. Or where the company otherwise demonstrates its commitment to diversity through a robust succession plan for its board and its executive committees, or in other exceptional circumstances. I mean, there are things you can't plan for, like a director resigning unexpectedly, or if a company has recently uplisted and is still playing catch up. So the key is that companies either need to meet the targets or disclosures need to be meaningful. And I would absolutely recommend using the toolkits at the back of the Parker Review and the Hampton-Alexander Review as a starting point. They're really useful.
Good tips. I mean, basic tip, but good tips. It's good to remind us of it. Moving over to Maureen. And Maureen, it is great to have you here with us today. So your key area at the FRC is all about the UK Corporate Governance Code. I understand that your team assesses the reporting against the code each year. Can you give us a little or any insight into what you are looking for and perhaps what you have seen so far this year?
Yeah, so every year we do a review of reporting. We select 100 companies randomly from the FTSE 350 plus a few small caps. And we assess them against the code requirements, application of the principles and the compliance with the provisions. And we produce our report generally in November each year. And it's interesting to hear what Courtney was just saying about explanations, because it's something that we look at every year. What we've said in the past and what we continue to say is, companies should not comply with the code if there's a good reason to do so. So non-compliance is a good thing if you can be transparent about it and you can give an effective explanation. But quite often what we find is that companies don't fully comply or try to hide non-compliance by saying in their statement, yes, we've actually complied with everything. And then you might look at, the chair and he's been there for like 10 years or something like that, which is more than the 9 years that we recommend, without an explanation. So what we've been doing for the last 2 years is really trying to get companies to kind of work on those explanations and up the transparency. I'm pleased to say that we're starting to see that over the last 3 years. There's been an improvement in both companies saying, actually, we've not complied, and these are the reasons why. But still quite a lot of work to be done on that explanation piece. As Courtney said, the timing, why, what you're going to do, what the mitigating factors are, all those things. And there's some guidance that we put out 2 years ago on what makes good explanation. So take a look at that as well. If you're interested, I can send links. Other areas that we're looking at, particularly this year, we're looking at engagement with shareholders. And this kind of links into what I was saying about the AGMs, trying to raise that engagement throughout the year and to report back on that explanation in the annual report. The Corporate Governance Code does say that the chairs should be involved in that engagement, and committee chairs should be if it's a material issue. Now, we've not found any committee chairs in our 100. We've done 84 companies so far, and not one disclosure of a committee chair being involved in engagement, other than a handful of REM chairs being engaged in shareholder engagement, which I find somewhat strange. We were talking about diversity, so where's the non-co chair in all this? Audit committees, there are always key issues around that as well. And the SID, we've only found 12 disclosures of a SID being involved in any engagement with their shareholders. And I think that's telling us a bit of a story. Maybe, companies just leave it all to their teams that do that engagement. But, investors quite often say to us, we really want to see these people at key points during the year, and we can't get access quite often. It's maybe one or two of the bigger investors that do it, but the smaller ones are there too, and they can be quite impactful as well at voting times.
Yeah.
So we're looking at shareholder engagement. We're also looking at stakeholder engagement, and that's improving. When we started this 3 years ago, companies would generally just talk about a little bit of employee engagement. We're seeing much more disclosure around engagement with customers, engagement with suppliers. Workforce is obviously the key one, especially post-pandemic. So we're seeing good processes, good practices emerging. What we're failing to see is that impact. So there's a lot of disclosure saying the company did X or Y, or we delivered a seminar, or we did a piece of engagement with a key team, but we're not saying what's happening to that. Are any of these issues getting back to the management team? Are they getting back to the board? What's the feedback to those stakeholders? So that's where more work is needed. We want that feedback loop. We want to see the impact and outcomes of that engagement going forward. And the other areas that we're looking at are risk, and we might talk about that a little bit more. I know you're going to talk about transformation, but we look at risk, and companies are asked to look at their internal controls processes and review their effectiveness. And every company does that, but they don't tell the reader how they reviewed that effectiveness, who was responsible for that, what the outcome was, what action they might be wanting to take. So we quite often get a bland statement said, yes, it was reviewed, all is fine. And we need a lot more disclosure around that. And as we talk about, where we're going in the future, that's a key area that we'll be looking towards. And just one final comment about nominations committees. Last year we felt that nomination committees were almost the Cinderella of the committees, almost. Getting very little time in an annual report. Succession plans were seldom revealed, and again, back to diversity, what's happening there. So the team and I plan to do a little bit more work on that over the next 6 months to see if we can get some good guidance out there for nominations committees going forwards to help with this diversity issue, but also, making them more relevant today and not being kind of pushed out by REM and audit.
Yeah. I get that. And just on when you're talking about shareholder engagement, so like committee chairs engaging with the shareholders, isn't it also typical that actually the nomination chair is also the chairman? So I think from a reporting perspective, I'm just looking at from a COSEC, in our mind, they have that. So when we're saying, the chairman, that he's the nomination chair as well. So I think there's an element of that already being engaged as part of that. But I understand definitely it's always satellite on the REMCO chair just because of the issues, isn't it, around, So just moving on when you're talking about risk and the transformation. So the government has issued its response to the consultation on the future of audit and corporate governance, which will have an impact on a number of different market participants, most notably, company directors, auditors and professional bodies, as well as changes to the code and another reporting responsibility that we issuers will have to do. How is the FRC and your team preparing for this?
We feel like we've been preparing for years and years. It was somewhat of a relief when the government response came out. So I'll just try to give you an overview of what we're doing and some of the issues that we're wrestling with. I should say that some issues will still require primary legislation, and there isn't a bill slot yet for this work. So, there will be more work down the line, and when BEIS get the opportunity to bring forward a bill, there'll be some primary legislation which will make us fully transfer, and Argo will become a real thing. But we can do a lot with secondary legislation. So the things that we're looking at the moment, audit committee minimum standards, that's something that we're working on at the minute. Not my team, but another team within the FRC. We'll be creating an environment where audit committees can do more to engage with investors, because that theme again, and the audit committee will be asked to do more and maybe engage at least once a year and maybe seek some assurance. So that's all around the audit and assurance plan that will be coming in the near future. There'll be revisions to all the guidance that we put out there. So guidance on audit committees, guidance on risk and internal controls, etc. That's what we're looking at. I think there'll be no formal US SOX regime. I think different views on that. FRC are on record of saying that's an opportunity potentially missed. Could have done more, but actually we'll be looking at the code to see whether we can put some of that into the corporate governance code. So we'll be looking at risk in their internal controls and seeing what systems that we can suggest within the code. And also, we'll be thinking about malice and clawback. That's something that the government talked about. They want us to be a bit more robust in that area in the corporate governance code. And much wider, there'll be wider powers for our company reporting team to look at reporting throughout the code. So normally they look at the financials and they write to companies about where they see reporting could be improved. But when there is legislation in place, they'll be writing to companies about issues relating to the front part of the report and accounts. So they'll be talking about governance issues, section 172 issues, whether the front and the back of the report actually link together, because we already know from some of the reporting on TCFDs and climate that great comments are made in the front part of the report about what companies are going to do, and then when you look at the financials, it doesn't always link together in a coherent way. So there'll be more work on that, and we expect the FRC to be given powers in relation to a wider range of directors. Currently, the FRC is only able to bring prosecutions against directors who have an accounting or members of an accounting profession. Will be given powers, we expect, across all directors, particularly in terms of fraudulent cases, things like that. So that's a kind of rattle through the areas that we're looking at. I can talk about the corporate governance code and the likely timings, if that would be useful.
Oh yes, I think that would be very useful.
Yeah. So what we're working on at the minute is informal consultation towards the end of this year. So we've got to work out where any changes to the code might impact on the resilience statement that we know is coming in. The viability statement that's already in the code, will that simply disappear? Will it be a watered down viability statement? How will that work with the resilience statement? The new standards for audit committees, if you're looking at part 4 of the UK Corporate Governance Code, there's lots about audit committees in there. So we'll need to determine how much of that we keep, how much we point to the new standards, where there's duplication. So there's work there to be done. So the idea is informal consultation towards the end of the year on many of these issues, with a formal consultation early next year. That's what we're thinking at the minute. Some of this might depend on whether we see draft secondary legislation from BEIS, which will allow some of the issues that we're talking about to be to link up with our changes to the code. But we'd hope to get it all done by the end of next year. That's the current plan. It might change, but that's where we are at the minute.
Well, certainly for our members, our head members, to be keeping in touch with you on that and around the timetable.
Yeah, we will be putting out a document next month, I think, that sets this out in a much more formal way. So all I'm giving you is our latest thinking at this moment in time.
And with those potential changes you're talking on those areas of looking around the code, and what might this mean for reporting? Would it become quite extended, or would it be more succinct? And you feel like you have to include everything, including the kitchen sink, just to make sure that. But how much as a shareholder reading the annual report, albeit we are pushing for electronic version, it's still pretty heavy reading.
It's very heavy reading, and my team reads such a lot of it every year. It's quite a task. We recognise this, and I know that there's some work going on to try and simplify some elements of reporting going forward. The FRC did its project on that last year, and I think there's still a lot of work going on to try and see where we can simplify things. I'm quite keen for the code to try and tighten it up a little bit. So, there'll be things that we have to change, but there might be areas where we can be a bit more specific about what we want. So we can just say, this is exactly what we want to achieve this provision or this principle, and to try and get rid of some of the kind of extra disclosures that are not always necessary. Also, better use of signposting. We see, and I'm sure everybody on this call knows that, annual reports have the same paragraphs cut and pasted in various different places, so that, again, to your point, everything's covered where it should be. So I think signposting is really important to get that right. It's in the section 172 statement. Does it need to be in the governance statement? If it's in diversity piece, does it again have to be in governance? So it's really thinking about how this fits together and getting the right bits of information in that report, so that everybody can say, well, if I'm looking at this, I'll find it there. If I'm looking at something else, I'll find it there. And really trying to keep it, clear and as succinct as possible.
Good. Thank you for that. So moving on from we can only try as COSEX. Moving on, let's touch on a little bit on ESG reporting and its requirements. And I'm going to let you off a bit, Maureen, so you can have a bit of a drink. I'm coming to you, Courtney. Most companies have now set environmental, social, and sustainability targets. Are these in the most part genuine targets, or are companies only greenwashing in their annual reports without any real measured changes to back it up? I mean, coming towards what Maureen's saying about meaningful and transparent reporting. What's your view on this, Courtney?
Oh, another great question and another really hot topic at the moment. ESG is part of a concept that's been around for quite a while now. It was previously covered under corporate social responsibility, otherwise known as CSR. Many businesses saw it as a box ticking exercise, and let's be honest, there's quite a bit of banding about of quite vague terminology, trying to appear environmentally friendly, but with not much to back it up. But I think that's changing now. Companies know that what investors want is genuine sustainability with real targets and actual evidence to back up any claims. And the targets are a lot more defined now. In October last year, the government published Greening Finance, a roadmap to sustainable investing, which helps companies to deliver a more sustainable future. And it outlines steps to help consumers to better judge the sustainability characteristics of products and firms, which is helpful. The government's also recently made changes to company law, which affects the UK's largest companies, including private companies with more than 500 employees and a 500 million or above turnover. And under the new rules, which are set out in the company's strategic report, Climate-Related Financial Disclosure Regulations 2022, the companies are required to state in their annual reports what they have produced, whether they have produced TCFD task force on climate-related financial disclosures, or explain why they haven't done it. And the FCA has also committed to challenging firms where it sees evidence of potential greenwashing and to take further action as appropriate. So investors will be expecting to see genuine ESG metrics in management and annual bonus targets as well, and that will have an impact. So I think there's less scope for greenwashing now that the targets are more defined, and investors and companies are more informed.
Good, and a lot of guidance on that, so it feels like you haven't got any excuse.
Exactly.
So although the focus on environmental aspect of ESG, it seems to be on issuers, and what I call the operating issuers. There doesn't seem to be a specific regulatory obligations for investment trusts to make disclosures on sustainability. Are you finding that they are choosing to do so voluntarily?
Yeah, well, sustainability is definitely becoming one of the most prominent topics with investors. And for investment companies, it's mainly associated with the actual process of investing and how it impacts climate change. So as the AIC has said, investment companies are particularly suitable for ESG investing, actually, because they have a closed-ended structure. So that means that they don't have to sell assets when investors sell their shares in the company. So they're able to take a longer-term view of their investments and invest in assets that have positive social or environmental impacts. They're also governed by an independent board of directors, so that helps to ensure accountability. And they're also listed companies, so they're quite transparent. So investors will want to ensure that they have access to clear and genuine information to enable them to make important decisions on what they want to invest in. And I think investment trusts are aware of this, and they're starting to respond to it by choosing to make the disclosures wherever they can. But the disclosures are currently free-form, with companies themselves left to decide what information investors will find most useful. So I think these will only improve with time.
Okay, so one to keep an eye on, isn't it? I appreciate that we're not through with this year's AGMC, and we're a little bit over halfway through. Are there any insights as to how proxy advisors' recommendations have been influenced by the new rules?
Definitely. All the proxy voting advice I've seen so far has mentioned the ESG reporting. And just as a couple of examples, IVIS has said that companies should provide a statement in the annual report that the directors have considered the relevance of the risks of climate change and the transition risks associated with achieving the goals of the Paris Agreement when they're preparing and signing off the company's accounts. As another example, PERC has also said that it expects companies to provide a summary of their environmental approach and their goals and performance within the annual report and accounts. And they recommend including disclosures about corporate strategy as it relates to environmental issues, and to provide environmental data, including things like energy consumption, greenhouse gas emissions, water consumption, waste, and whether or not they actually use environmental audits. So I think it's quite clear that proxy voting agencies are expecting to see these types of disclosures.
I think we just need to move on from this, but for those wanting to get more details on ESG reporting, we are running a training course on the 4th of October. Details are available on our website through the head channel. So please have a look, and if you're interested, please register. So just moving on from sort of like ESG, and then in a way this whole sustainability and sort of the environment is connected. Obviously, the war in Ukraine sadly continues. UK has joined with the US and EU in imposing unprecedented sanctions on Russia in response to its full-scale invasion of Ukraine. This has included measures against its central bank and financial sectors and the targeted asset freezes of individuals and companies. So Jay, coming to you, with the list of sanctions growing, what is Link Group doing to review those lists and keeping issuer clients compliant?
Well, to be honest, I imagine it's rather like painting the Forth Bridge. The sanctions list is currently the largest I think it's ever been, and requires us at Link to review each of the registers for matches on a regular basis. So clearly, that's an enormous task. It requires dedicated resource. So given the size, what we have done at Link is built dedicated programs and processes that sweep the registers. We extract the output of any matches, and where there's a high degree of confidence of a match, we then talk to our issuer companies about what the next steps are and what needs to be done. As regards encoding the register with restrictions, for example, to prevent any movement or the payment of dividends and the like. So, yeah, I mean, just to recap that, the list is growing all the time. So every change needs to be reviewed. There's a regular review process of the existing stuff as well, because what you don't want to happen is someone on this sanctions list suddenly appears on the register having not been there before. So we need to check for that too. And that is an ongoing process. It's turned it almost into its own little cottage program.
And so how do the sanctions lists impacts on nominees company and the intermediate investor model then, Jay?
That is a really important question, actually, because the registrars and the issuer, as you know, will have limited, if any, visibility at all of the complete intermediated chain. So amongst all of that intermediated chain, we've got layer after layer after layer of investor until you get to that end one. And that end investor could be a sanctioned entity. But of course, the custodians and the nominees and the banks themselves are also bound by the sanctions list requirements, and they too will be scanning their memberships for matches. So it's incumbent on them to advise where they find a match. Now, if they are identified, those nominees, the banks, the custodians, they'll need to impose restrictions to prevent any economic benefit, which would include, I suppose, the payment of dividends, exercise of voting rights, etc. So what that means is that the nominee or the custodian level or the sub-custodian level, a restriction might be applied, which we might not know about as the registrar and as the issuer company. And I think it's incumbent on actually the nominee or the sub-custodian to actually report that they have found a sanctioned entity. And when they do, and if they do, we and the issuer will make changes to the register for that whole entity to restrict that part of the shareholding that would be subject to the sanction, so that there would be no economic benefit to be passed through the chain in relation to that sanctioned individual. So it's quite a complex process. It requires all of the intermediaries, all of the steps in the chain to follow the sanctions list and the processes and procedures that are required and governed to identify any sanctioned entities. And where that all happens and all comes together, and it does, that those restrictions are put on the register. As I said at the very beginning of this, the sanctions list is growing to an enormous rate. It's gone are the days where one or two entries would be made ever so often, and those could be checked through on a periodic basis. This is a daily occurrence. This requires daily feeds into our system, extracts to be provided, monitoring, compliance, auditing, and the work. So as I say, it's become a very important function for the registrar to ensure that companies and issuers remain compliant and don't pass any benefit to any sanctioned entity that they would otherwise be benefiting from. So in a long roundabout sort of way, Kathy, we're doing everything we can to help companies and support companies in their obligations. We work with our peers and the market infrastructure generally to ensure that everyone remains compliant.
And then you know what, Jay, absolutely, it sounds too complex for my head to get around this. I'm so glad you are our registrars, honestly, Jay, and that the registrars, you guys are on board on this.
Thank you.
So, Courtney, coming over to you, from a COSEC perspective, what are the responsibilities of governance professions in relation to these sanctions?
Sounds a lot easier actually than what Jay has to do over at his side. The CGI has recently published some really good guidance on this, which is super helpful. Responsibilities for the company secretary include things like raising the issue with the chair and the board to check that they're informed about the issues, including reputational issues given the heightened political and public interest in this at the moment. As Jay mentioned, it's important to check sanctions against the share register, and especially important for listed companies, and to make use of Section 793 of the Companies Act to identify whether there are any shareholders who are prescribed individuals if you don't already know about these shareholders. Companies should also be encouraged to arrange an exercise to be carried out to identify underlying assets held by Russian individuals, banks, and entities. And the board should be reminded that breaching sanctions carries a potential criminal sentence, and D&O insurance won't cover them for that. So this is really important stuff. Governance professionals need to pay close attention to the situation as it evolves, make sure that they're checking for any updates, and support their chair, CEO, and board.
Good. All really good advice, Courtney. So moving on from sanctions, and I think we've got a couple of minutes before we go into the Q&A session. I think at the beginning I mentioned about some reforms to Companies House that's come through, Courtney. Could you give us an executive summary of what's happening and maybe some practical implications for us governance professionals?
Sure. Well, you might remember in 2019, BASE published a consultation on reforms to Companies House. It was to tackle fraud and money laundering. But at the time, it noted that the transformations would take several years to deliver and were unlikely to happen until 2022 at the very earliest. Well, finally, in March, the government published a white paper setting out its response to the consultations. And it laid down the government's plans for the overhaul of Companies House, changing it actually quite significantly from quite a passive receiver of data. It will be given a much more active role in verifying the data and maintaining its reliability. So the government plans to introduce compulsory verification for all new and existing company directors and people with significant control, otherwise known as PSCs, as well as introducing a ban on corporate directors. So those that set up, manage, and control companies and other entities will have a verified identity with Companies House, or they will need to be registered and verified with an anti-money laundering supervising third-party agent. So this will make anonymous filings harder, and it will discourage those that are wishing to hide their company ownership through nominees or really opaque corporate structures. But particular implications for company secretaries will be that we need to start thinking of Companies House as more of a gatekeeper to information rather than just a passive recipient. We should be organizing the verification of the identity of directors and PSCs. We'll need to review any corporate director arrangements to ensure they meet the new requirements. And at this stage, it's still unclear on what basis information might actually be removed or declined by Companies House and how thorough checks on the information will be. But the government has said that it will introduce legislation to Parliament to effect the reforms in the coming months, so it should be coming up fairly soon. And it's part of a wider package of legislative proposals to tackle illicit finance. But this is a big deal. This is being described as the biggest change to Companies House since its formation. So watch this space.
Definitely want to watch this space, guys. And now we move on to our Q&A session. I think we've got about 9 minutes, guys, so no pressure. We've got quite a lot of questions, so I'm just scrolling through it. Oh, here's one probably for you, Courtney, from a COSEC, and maybe Maureen from a reporting perspective, just for next season's reporting. We got a question here asking what key questions for the second half of 2022 should COSEC be asking on the board? What should the board be focused on for the second half of 2022?
Well, I mean, I guess it depends on your year end, but absolutely, what are we doing about diversity on the board, how we're going to handle that, what plans do we have in place, how we're going to report on it, and also ESG, the other big topic. What are we doing about that? We need some really robust explanations if we're not complying with all of these things. So I think if you haven't already brought them up with your boards, they should be on the top of the agenda going forward this year.
Yeah, I'd echo that. I'd also talk about net zero and climate being very specific issues that investors are looking at really carefully at the minute. Lots of discussions about whether there should be a vote on climate and things like that. I don't think we're going there at the minute, but I think the more companies kind of put their head above the parapet on these issues and are transparent and have robust processes in place, then the less likely it is that there'll be more rigid requirements placed on them. So I would say, yeah, all the ESG issues, definitely. And I would always say, remember to tell your company story. Tell them, tell the board that it's important that you don't follow the herd. Tell them exactly what it's like for your company.
Okay. Just a follow-up question on the ESG bit, given the current economic background in the UK and, the possible recession and so forth, do you anticipate that the social element of ESG will become more prominent and could be at the detriment of the current focus on the E?
I can talk a little bit about that, Kathy. So yes, the social aspect absolutely will become more prominent, and we're already seeing this. I have seen letters from institutional investors saying that they will be focusing on the Modern Slavery Act and companies' modern slavery statements. And I think it's really important. It should be focused on. Do I think it will be to the detriment of the E? I don't think so, because that's another really big topic. And it's something that companies and investors are really, really keen to get right. So I think they'll both be big topics going forward.
And Maureen, do you agree?
Absolutely. I mean, the S, when we were in the pandemic, the efforts that companies put into their workforce, much more work on diversity. Interesting you mentioned modern slavery, because we looked at that last year, and there's lots and lots of work to be done there. And I think it's really important to recognise that these are not trade-offs. The things that is important to everybody. You don't trade off the E with the S or the G with the E and the S. The governance brings you to the E and the S. And if you get the E and the S right, and you've got strong governance, then you'll be a strong company. If you start to fail on governance and don't have the right processes in place, then whatever you do on some of these issues, it's going to fail anyway. So I don't think it's an option. I think you've got to do as much as you can in all the areas, unfortunately, but fortunately.
Kathy, I was just going to add, a small addition to the S versus the E versus the G is the soft launch of the dormant assets, the expansion of the dormant assets scheme later this year with a further release, a wider release in 2023. And I think a lot of companies will find that they need to start thinking about how best that they can socialise the dormancy that they find within their registers. The beauty about the dormant asset scheme in many ways, and what companies can do either to participate or otherwise, is it ticks all the boxes. There's a good environmental message here. There's a great social message here. It's good governance to make sure the register's up to date. So I think in answer to your earlier question about what companies might need to think about towards the back end of this year, that's going to be, it's a small part, it's a small thing to think about, but I think what's going to happen in the future is the larger investors are going to start pushing for what are you doing about your dormancy within the register? How are you best utilising either outstanding funds or relocating or reallocating those funds to either back to the original investor or for good causes? So we're going to see a little bit more about that later this year.
One on the watch list, Jay. Since you've appeared to me, Jay, there's a question actually for you. And maybe Courtney as well, if you'd like to jump in, is do you think the re-emergence of action by Extinction Rebellion at recent AGMs will impact on the future directions of AGMs and could have an adverse impact on the wider shareholder engagement at AGMs?
Yeah, it's a great question. I think demonstrations at AGMs are a serious concern for companies, not only in terms of the disruption it causes, but actually the health and safety of the whole event. I mean, if these are outside of the event, I guess, providing it's properly policed, then I don't honestly see much of an issue with it. But it's when it comes into the actual event, it causes a real problem. And companies will be thinking about it. I'm sure, if we can have a virtual meeting, if our articles permit, and we can get over the place of the meeting issue, then actually that resolves a lot of those problems. The activists are not going to be able to be as visual as they would like to be. Hybrid will help, obviously. Will it impact on engagement? No, I don't think it should. I think companies need to engage with shareholders, the right thing to do. Shareholders should be engaging with companies too, in fairness, and a lot aren't. And if companies are doing the right thing, they're doing the right environmental stuff. They're approaching on an absolutely full speed ahead on net zero objectives. Then actually these type of demonstrations won't affect them. So, it's a very simplistic view, I know, but I think, yes, companies are probably concerned about some of these demonstrations, especially the extractive companies, the oils and the rest, but there are ways to mitigate it, I think.
Okay, thanks, Jay. Look, we've only got a minute left to our session, and we've got many questions that are pouring in. So we could talk all day, right? But we're coming up to lunchtime. People will probably want to stretch their legs and go out. Those who travel into office will go out and pop if there's any shop to get a sandwich. Questions that we haven't answered, we're going to get our the responses sent back to you guys from our expert speakers. But just to kind of wrap it up, Maureen, can you do a quick summary, a key takeaway from this session? And I invite Courtney and Jade the same from your side.
I think there's a lot going on, and I think we've mentioned a lot of those key takeaways. ESG reporting is something that everybody's got to look at. And I would just say what I said a minute ago, be succinct. Try and think about the impacts of your reporting, not just the processes. So where the processes lead to an impact and an output, that is very much what we want to see. And again, tell the story of the company.
Okay, Courtney?
Just to repeat what I said earlier, so far this year, board diversity and ESG have been the hot topics with directors in the boardroom and with investors and proxy-facing agencies. So I think these topics will be around for a long time, and gone are the days when a simple explanation will suffice. Investors are expecting more, and they will wield their power by voting against the re-election of key players on the board when there's non-compliance or a watertight explanation to back it up. So it's more important than ever for company secretaries to keep up with the guidance as it evolves, and it is evolving, and to raise the issues with the board as soon as possible so that they have time to ensure that they've taken substantial steps to address any issues.
Okay, thank you. Jay?
I think thus far we're seeing a continuance of the change that we witnessed over the last few years with the move to the digital process, more digital. That's going to likely increase with better infrastructure, I think, as we move forward and better shareholder engagement. Dare I mention dematerialisation? That is being spoken about a bit more now. That's going to greatly impact digitalisation when it arrives. No doubt we'll have to look at DLT and blockchain solutions. So how will they feature, if at all? And there's going to be deliberations happening on that over the coming months and years, I suspect. All in all, we're in for a period of all change, I think.
Okay, thank you, Jay. Well, look, all that remains for me to say is a big thank you to our expert speakers and to everyone watching us from the comfort of their home or at the office if you made it through, managed to get a train in today. We will be sending out a follow-up email with today's recordings as well as details of our next event, which is not far off. So look out for that, which will be hitting your inbox shortly. Last thing for me to say is have a great day, and I hope to see some of you in person at the CGI conference in a couple of weeks. Bye-bye.
And that is a wrap. Thank you to all our speakers for some really interesting insights. And thanks to you for listening. If you want to take part in future events, I've left a link in the description. You can also subscribe on whatever platform you're listening to us on. That way you won't miss an upload. Take care.